One of the most essential but often misunderstood principles of successful investing is asset allocation. It's not just a technical term used by experts. Asset allocation is the basic structure of your investment plan. It helps you balance risk and reward based on your financial goals, how long you plan to invest, and how comfortable you are with market ups and downs. With more people managing their own investments, knowing how to create a well-diversified portfolio is more important than ever. Whether you're dealing with market swings or planning for retirement, asset allocation is a powerful tool to manage risk and stay on track. To help us better understand this vital concept, we're joined by Tony Ciero, Vice President and Senior Portfolio Manager at Caldwell Securities Limited. Tony, thanks for being with me today.
Pleasure, Theresa. Thank you.
Now, before we get into that topic, I do want to start with what's going on in the Middle East. Whenever we see major geopolitical shocks like a U.S. military strike on Iran, markets react. What are the typical first signs of an impact on a Canadian financial market?
Well, right away, we know the price of oil is going to surge. The Canadian market is, Canada is a net exporter of oil. And anytime you have disruption in the Middle East, in particular Iran, which is a global producer, you're going to see the price of oil go higher. And we've seen that. It isn't just because of the last couple of days what the U.S. got involved, but it was just the threat of Israel attacking back at the beginning of June, and the price of oil was around $60, and now it's stabilizing in around $70. So a $10 increase in a relatively short period of time has definitely aided that. Vis-a-vis the Canadian oil, we also then see the Canadian dollar strengthen. The Canadian dollar is a commodity currency, meaning that the price of oil will have more say in the fluctuation of our currency than, say, any monetary policy that the central bank does, the Bank of Canada does. With the positives, though, you have to look at the negatives too. Generally speaking, any disruption, threat of nuclear war is going to cause a market animosity, and you're going to see volatility. And a lot of people then go to more safer investments, so they'll sell off their stocks and look to buy cash and bonds, more safe haven investments.
Now, to get back on topic, let's talk about asset allocation. So do you mind breaking down what exactly that is?
Simply put, asset allocation is a diversification strategy for your investment portfolio. And there's four main baskets or broad asset class categorizations we can invest in. The first one is cash and equivalents. The second is fixed income or bonds. The third is equities or stocks. And the fourth is known as alternative investments. And by alternative investments, we mean anything outside of cash, bonds, and stocks. So things like hedge funds, real estate, commodities, oil, for example, are considered alternative investments. The trick is knowing how much of your investment portfolio to allocate across those four main asset classes. And if you know exactly how much to put across those four asset classes, then you have achieved your target asset allocation.
And why is it important for investors to know what their target asset allocation is?
Yeah, great question. And the main reason is it can help you achieve your investment goals. You have your investment portfolio today and you want to project it over a long period of time. Is it for retirement? Is it for, the next generation? Knowing your target asset allocation can help you achieve those goals. More importantly, though, it can help you ride the ups and downs and swings of the markets. A more diversified strategy can protect capital, especially in periods of downturn, where if you're too nervous, you might sell out of your portfolio too early and not help to achieve the long-term potential return of your portfolio. So it can help stem the ups and downs of the markets.
And what is target asset allocation based on?
Two components. First is the return you need on your investment portfolio to hit your investment goals. And the second, more importantly, is the risk you're willing to take to achieve that return. And that risk I equated to the can I sleep at night test. At what point is too much downturn in the markets going to cause you to lose sleep, call your advisor the next day, and sell out of your portfolio? Knowing your target asset allocation can help you prevent you ever reaching that point.
And are you concerned that many do-it-yourself investors are not getting the advice that they actually need?
Yeah, absolutely. Generally speaking, do-it-yourself investors, they're more focused on stock selection and market timing. I can't tell you the number of times I've been asked once they find out what I do, my profession, should I buy this stock? Should I get into the markets now? And that's not a strategy for the long term. It's proven not to succeed. So yes, a big concern. Another thing I'll throw out there is it's very widely known that over the next couple of years, we'll be seeing an inherent tsunami. Generally speaking, about $1 trillion will change hands from one generation to the next. And if the next generation is do yourself and you're all of a sudden got all this wealth, you become the steward of that wealth that your parents or grandparents created. So you have a lot more responsibilities than just trying to pick the hot stock or trying to market time out there.
And with people coming into that much wealth, what advice would you give them to be responsible with the money that they're inheriting, but also, spend money and be happy and enjoy it?
Yeah, exactly. Well, consider an investment philosophy that works for you. And one thing that we do for our clients here at Caldwell is this concept of core satellite investing. So that's the advice I would provide, where the core part of your portfolio is your target asset allocation. It'll help you achieve your long-term goals based on the return you need and the risk you're most comfortable taking on to get that return. Now, the satellite component can be that part that you're trying to hit the home run. You're trying to pick the hot stock out there. You're trying to market time. But you want to make sure that when you put this core and satellite investment portfolio together, that not one single idea, one single hot stock has a propensity to derail the overall performance of your portfolio. Keeps you on track for the long term and maintains the integrity of your overall goals.
And with what the market is looking like right now and what it's going to continue to look like in the future, why is asset allocation important for young people or people that are making money to understand?
Again, I almost want to call it's a cheat code if you're a gamer, but it's not a foolproof plan. It's not a guarantee out there. And the cheat code is terms when markets are stressed, like we're seeing lately because of the Iran concern there. Also, when the Trump tariffs were announced, Liberation Day back in April there, we saw a lot of market volatility. But again, if you have a properly diversified portfolio that's hitting your target asset allocation, you won't be succumbing to these extreme ups and downs. You'll ride a smoother wave. And at the end of the day, it'll help you stay invested in order to achieve your long-term investment potential.
Well, Tony, thank you so much for the time today. We appreciate it.
Theresa, pleasure. Thank you.